Hello everyone and welcome to episode number 42 of JustDario Cigar Time. Today we have really a lot to talk about, so stay with me till the very end because it's gonna be another incredibly interesting one. First of all, we're going to talk about the big buzz around all Wall Street and markets about the BLS coming job revision, the incredible stress that we are now seeing overall from a political perspective, a socioeconomic perspective around the globe. And then what traders can really do to prepare themselves for what it can be the burst of one of the biggest, if not even the biggest, bubble in history. Today is the 8th of September 2025, and tomorrow on the 9th, the Bureau of Labor Statistics is dropping what they call the preliminary benchmark revision to the last year's job numbers. If you're not a financial expert, don't worry. I'll explain it step by step to you. We'll cover what these revisions are, what traders on the market are expecting, and why a big surprise here could mean the private sector, think everyday business hiring people, basically didn't add any new jobs for most of President Biden's time in office. Every month, the BLS releases a report called the Employment Situation, which tells us how many jobs were added or lost in the US. It's based on surveys from thousands of businesses and households. Sounds straightforward, right? But here is the thing. These initial reports are a first draft. They are estimates because not every single company reports right away. And the data isn't perfect either. So the BLS tweaks these reports later to make them more accurate. And these tweaks are the revisions that are going to be published tomorrow. To understand this better, let's delve into how the BLS operates. The monthly employment situation reports is one of the most anticipated economic releases, often causing immediate market volatility as investors react to the headline figures on non-farm payrolls, unemployment rates, and average hourly earnings. For instance, the August 2025 report released just days ago showed only 22,000 jobs added, far below the expected 75,000 to 80,000, making the weakest monthly gain since the COVID-19 crisis in 2020. This slowdown has heightened anticipation for the benchmark revision, as it could retroactively alter our view of the labor market's health over the past year. Now, most revisions happen month to month or a few months out, but once a year, the BLS does a big one called the annual benchmark revision. This is tomorrow's event. It uses super detailed data from things like tax records and unemployment insurance reports, basically the full picture from nearly every employer in the US. They use this to re-anchor the job numbers for the whole previous year, usually adjusting the total employment level as of March. For the 2025 revision, it's looking back at data through March 2025, which covers most of 2024. These can change not just the total jobs, but also how we see monthly gains or losses over that period. In simple terms, it's like correcting a report card after the teacher double-checks all the tests. Historically, these benchmark revisions have been significant. For example, in the 2024 revision released last September, the BLS downwardly adjusted non-farm payrolls by 818,000 jobs, the largest negative revision since 2009, which contributed to the Federal Reserve decision to implement a 50 basis point rate cut shortly thereafter. This process involves reconciling the sample-based current employment statistics survey with more comprehensive data from the quarterly census of employment and wages, which covers about 95% of US jobs through unemployment insurance records. The preliminary estimate released tomorrow will provide an initial gauge, with the final revision coming in February 2026. Analysts note that the recent monthly revisions have already been downward, such as the June 2025 job gain, flipping from a positive figure to a loss of 13,000 jobs after adjustment. This pattern suggests the upcoming benchmark could be even more substantial, potentially shaving hundreds of thousands of reported job growth. Job numbers are a huge deal for the economy. They influence everything from stock prices to interest rates set by the Federal Reserve. If the revisions show fewer jobs than thought, it paints a weaker picture of the job market. Like, hey, the economy wasn't growing as fast as we said. Right now, with the job market already cooling off, we just got a report showing only 22,000 jobs added in August, way below expectations. This revision could confirm that significant slowdown in the economy. In fact, the 3 months average job growth has fallen to just 29,000, the lowest in 5 years, signaling a broader labor market deterioration that could prompt aggressive Fed action. To expand on this, the BLS methodology relies on two main surveys: the Establishment Survey payroll data and the Household Survey for unemployment rates. The Establishment Survey, which forms the basis of non-farm payroll, samples about 122,000 businesses and government agencies representing roughly 766,000 work sites. However, initial estimates can be off by as much as 0.4% due to incomplete responses, seasonal adjustments, and birth-death modeling to account for new business formations. The benchmark revision corrects this by aligning with the comprehensive QCEW data, which in past years has led to a net downward adjustment during periods of economic uncertainty, such as the 598,000 job reduction announced for March 2024. Economists emphasize that while revisions are normal, averaging around 50,000 to 100,000 jobs per month, the annual benchmark can swing by hundreds of thousands, reshaping narratives about economic recovery. For context, during the post-COVID rebound, initial reports overstated job gains, only for later benchmarks to reveal a more modest picture, influencing everything from fiscal policy to investor confidence. Furthermore, the August 2025 report highlighted sector-specific weaknesses. Manufacturing lost 12,000 jobs, continuing a trend of decline amid global trade tension and supply chain disruptions. Leisure and hospitality added some position, but overall, the data underscores a cooling labor market that the benchmark revision could exacerbate. With the Fed's next meeting on September 17, 2025, the timing of this release couldn't be more critical, as it feeds directly into rate cut probabilities, currently priced at over 90% for a 25 basis points reduction, with the chances of a 50 basis point cut at already 10% and rising. In summary, the BLS benchmark revision isn't just a technical adjustment, it's a window into the true state of the US economy, potentially revealing overestimation in job creation that have propped up perceptions of strength under the current administration. As we await tomorrow data, markets are on edge. Okay, now, what are traders' expectations? Right now, traders are bracing for a whooping downward revision, meaning fewer jobs than the original reports showed. Economists at places like Goldman Sachs are estimating a cut of around 550,000 jobs or more to the non-farm payrolls for the year from April 2024 to March 2025. What the forecasts point to is something even bigger, like 800,000 to 950,000 jobs shaved off, or even nearly 1 million vanishing from the books, as one report put it. That's huge. For context, the original data suggested about 1.8 million jobs added over the year. If it's revised down by 800,000, we're talking about an average monthly gain dropping from 149,000 jobs to maybe 88,000 or less. Why are traders expecting this? Recent monthly reports have already showed downward revisions, like June's jobs gains flipping from positive to a loss of 13,000 jobs. Plus, other indicators like private payroll data from companies like ADP are showing slower private hiring. Traders so far are bullish on US Treasuries, meaning they're buying them up because weak data could push the Fed to cut interest rates to boost the economy. Lower rates make borrowing cheaper, which is good for stocks and home buyers, but it signals that troubles in the job market are really starting. To unpack Goldman Sachs' estimate, the research team, drawing from unemployment insurance tax record and other comprehensive data sets, projects a downward adjustment between 550,000 to 150,000 jobs for the 12 months ending March 2025. This will represent the largest annual downward revision in 15 years, surpassing potentially the 818,000 cut from the previous year's benchmark. As noted in a recent analysis, This revision could translate to average monthly job growth between 88,000 and 110,000 in the 12 months through March 2025, compared to the previously reported 149,000, highlighting a significant deceleration in hiring momentum. Other institutions like Nomura echoed this with forecasts of 600,000 to 900,000 fewer jobs based on discrepancies between survey data and actual tax filings. These revisions stem from over-reliance on birth-death models in initial estimates, which assume net job creation from new businesses but often overestimate during slowdowns, as seen in the post-2008 period, where similar adjustment revealed hidden weaknesses. Now, the big what-if part. What happens if these revisions are as significant as expected? And specifically, how could they show that the US private sector didn't create new jobs for most of the Biden administration? Biden took office in January 2021, so his full terms run through January 2025. The job market boomed early on in recovery from COVID, but critics have long said the numbers were inflated, especially in government jobs, while private businesses struggled more than what it was portrayed. If the revisions confirm a massive downward adjustment again, it could mean that over much of 2021 through 2024, private sector job growth was flat or even negative when you strip out government hiring. Recent tweaks have already hit both public and private jobs, and analysis suggests hundreds of thousands of Biden-era jobs were overestimated. For example, if private payrolls get revised down sharply, it might reveal that businesses weren't expanding as much as reported, maybe due to high inflation, supply chain issues, regulation, or a combination of any of them. Fact checkers have noted that while total jobs reached record highs, much of the gains were recoveries from pandemic lows, and private sector addition averaged lower than under previous administrations when adjusted for revisions. These would mean the strong job numbers we heard about were propped up by federal, state, and local government hires, not engine of the economy, which are private companies. The consequences economically could rock markets. Stocks might dip if it signals a recession risk, while bonds rally as rate cuts look more likely. At least this is what was happening before, but now I do expect that this will increase the probability of Fed rate cuts, and the market is already pricing that. If it looks like that under Biden, the recovery relied on public spending rather than organic private growth, making the economy look shakier than advertised, then everyday folks might feel it in lower wage growth or job security, especially if it shows that private sector was trading water for years, and this can start impacting markets at last. Depending on Fed expectations, markets are now fully pricing a 25 basis point cut at the September 17 meeting, with total cuts of 100 basis points by March 2026. Standard Chartered and Bank of America have revised forecasts to include aggressive easing, citing the weak jobs data as a harbinger of recession risk. Political senators like Rick Scott has slammed the numbers as lies on the US economy, something I did for such a long time I even forgot when I started doing so, arguing they mask underlying weaknesses in private hiring. If revision confirmed flat private growth, it could fuel big debates on the real strength of Bidenomics. All in all, I believe that we will see a double reaction from markets. If the job revision comes in at levels that are expected, then markets might really be bullish about pricing even more aggressive Fed cuts than now are paradoxically pricing up to 6 rate cuts for next year. This is an incredible amount considering the level of inflation, even considering what Powell warned about during his latest Jackson Hole speech, as I analyzed in episode 40. If job numbers revision come even worse, then we need to be careful here, because even if traders might celebrate at the beginning, then people might start wondering, hold on a second, but we're buying stocks, and stocks should be expressing the value of companies in the real economy. But if the real economy is doing so badly, is it justified for stocks to trade at these levels? And this might paradoxically spark panic in market. Panic that might spread very quickly. Honestly, I don't think that in the current environment, we can see a risk-off bid into government bonds because, as I said in the last week article, The Global Debt Crisis, Why Gold Keeps Shining While Debt and Currencies Crash, Now we are in a very high inflation environment. And even if traders bought bonds significantly last week, then we have to come to terms to that. In particular, long duration government bonds are no longer a safe store of value as an investment. And the fact that gold continues breaking all-time highs after all-time highs every day is a sign of a huge paradigm shift, as I already warned about in my podcast last week. While traders are waiting for this big news coming from the BLS, and again, I think there will be a huge political component here because the Trump administration has all the interest to show that Biden did a very poor job and they cheated on the data, especially in the sunset of his administration. During the weekend, we got another massive news, the resignation of Japanese Prime Minister Ishiba. And what was the market reaction? Like, stocks in Japan cheered up to that, and the Nikkei closed at a new all-time high. I mean, isn't this completely nonsensical? What is even this narrative about? The narrative is that the market expects the next prime minister might embrace more fiscal expansion. But hold on a second. Wasn't this exactly the narrative that anticipated the Premier Ishiba taking office less than a year ago? Yes, it was. And then, when this guy came to office and looked at the books and looked at the state of the finances of the Japanese administration, he warned explicitly that Japan might be heading towards bankruptcy if they continue down this road, that this level of spending is not sustainable, that they need to get back on a more sustainable economic and monetary policy. And yet, markets completely ignored it. They kept going higher and higher no matter what, highlighting how effectively traders have become completely numb to risk in markets right now due to so many years of reckless money printing and liquidity injection from central banks, starting from the Bank of Japan that has been the precursor of QE infinity. At the same time all this mess is happening in Japan, in France in a few hours there will be the start of a vote of confidence on the government that can create a huge political vacuum in one of the core countries of the European Union. France, that as of now is really flirting with a big shock in markets. And I mean, if it continues to rise at this pace, imagine what is going to be the effect of interest rates on French government bonds starting to be higher than the ones of countries like Italy, that for many years were considered the sick man of the European Union. In France, Prime Minister François Bayrou faces a near certain defeat in today's confidence vote over austerity measures, potentially marking the third government collapse in 12 months under President Macron. The vote, tied to a contested budget amid EU pressure to cut deficit exceeding 5% of GDP, risks elevating far-right leader Marine Le Pen's influence. French 10-year yields have already risen above Italy in some parts of the curve for the first time in years, signaling market doubts about fiscal stability, with off-balance sheet liabilities like pension commitments pushing effective debt-to-ratio to unsustainable levels. This political vacuum could trigger a Eurozone crisis, reminiscent of 2011 when Italian yields spiked amid similar instability. UK is in another mess, with the vote on government budget already delayed into later in November. Several ministers resigning, like many protests going on all around the country. Government bond markets are showing signs of nervousness, but still it's not as much. If you look at fixed income markets, the British pound remains very strong. The euro on its part remains very strong against the US dollar as well. And this is completely nonsensical, especially when people are starting to become more and more aware of all the off-balance sheet commitments all these European governments within the European Union are not reporting into the total debt. For the UK, Chancellor Rachel Reeves delayed the budget to November 26, 2025, amid market uncertainty and resignation, including Deputy Prime Minister Angela Rayner over a tax scandal and Development Minister Anneliese Dodds protesting aid cuts. Protests rage all over the country over housing and fiscal policies, yet the pound holds strong against the dollar, defying logic given unreported liabilities that could balloon debt to GDP to above 200% when including guarantees and future obligations. Prime Minister Keir Starmer reshuffle aims to restore authority, but analysts predict bond yields could skyrocket if hidden debt surfaces, forcing BOE intervention that exacerbate inflation. The ECB is likely going to follow suit in this situation, Of course, they can print money. They can start buying government bonds as they did before in the semi-permanent situation of stress. But in the current environment, that is going to be really a double-edged sword because that is going to inject even more liquidity and push inflation even higher. That eventually will push these rates even to a whole new level that the world completely forgot about, because the last time we saw it, it was in the 70s. And many of the people in the professional environment today, not only in the financial sector, but pretty much everywhere, are not even in the workforce anymore. Gold surged to $3,600 per ounce this month, reflects this big paradigm shift driven by rate cut bets and geopolitical risk. Gold is already up 32% year to date, forecasting previous analyst expectation of $3,200 average by the end of the year. As inflation lingers above 3%, long duration bonds lose appeal, with 1970-style stagflation risk looming if central banks resume QE. The fact that despite all our skepticism, stock continue to rise is completely an absurdity. But by now, we shouldn't be surprised about that. However, everyone needs to be very careful because all these incredibly fragile balances that are existing right now across financial markets all over the world, with governments, social stability, and political stability, and so on, trembling, can really break at any time. Banks right now are really running out of room to support the whole situation. And I reiterate my call that even if the Fed cuts rates when other central banks continue into their loose monetary policies, the only thing that all these people can achieve is to continue kicking the can down the road. I want to be clear, I'm not a bear, I'm not a bull, I'm just a person that is presenting you with facts. And everyone can do whatever they want with it. You can be using them on your trading strategy, depending on your approach to markets or whatever. Feel free to make your consideration. As you know, personally speaking, I'm always having a very long-term view and mindset in whatever I do. This makes me bullish on things like physical gold and silver, relatively to Bitcoin on a certain extent, and in some extremely undervalued dark corners of the crypto market, like very small up-and-coming projects that are building out real useful technology, but are completely lost in the 99.9% of garbage of millions of tokens, meme coins, and whatever else that is polluting the crypto ecosystem right now. On the other side, how can you be bullish on stocks right now? How can you be bullish on government bonds? With regards to this, everything is pointing towards a big bubble burst. And these two are going to be the one that are going to suffer the most because they've been the most inflated one through the years. It has been just reported that the amount of treasury bills Warren Buffett has right now at Berkshire Hathaway is $334 billion, way more than the Federal Reserve. I mean, why do you think this guy is doing that? As I've been saying many times, Warren Buffett is 95 years old, and despite that, he's still thinking long term, and he's piling up cash as much as possible because he knows things are going to evolve. And he's preparing himself to do another bottom fishing buying when people will basically not be willing to hold any stock and any price, no matter what, in their hands, because everything at that time will feel radioactive. He's not even accumulating long-term treasuries because he knows what is the state of inflation and he knows how unsustainable is government debt and deficit. With the US government potentially coming again to a showdown the 30th of September, facing another federal government shutdown. A very interesting thing that I said during a call last week that I held with a bunch of investors that asked me for my personal views on many matters that I covered completely for free. And this is why I'm happy to share with you, because at the end of the day, this is my passion and my hobby. What I say is that nowadays it's wrong to approach all that's happening from a macroeconomic perspective or from a microeconomic perspective based on laws and theories that were built in a completely different market environment and structure. Some theories are even dating back like 40 or 50 years or whatnot. Some very strong laws in markets are still withstanding and carrying their weight, like Milton Friedman's approach on monetary inflation and all the various warnings about that. But what's happening right now is that we are in a completely different world driven by behavioral finance to an extent that never happened before. This created a complete detachment from reality, and the detachment that is not sustainable. Everything sooner or later in finance reverts to the mean. And the longer you're detached from the real stable footing and the equilibrium between markets and the economy, the bigger is the gap between the two, the more painful and disruptive is going to be the correction and the return to equilibrium. Everyone right now, let me stress again, should prepare themselves to deal with this sooner or later and to protect their financial wealth and personal stability in this crazy environment that we are experiencing. No matter what, everything can start in few quarters. It can take a little bit longer or whatever. But surely it is that everything is pointing towards a very big reset. And all the information that we have are saying that we are at the very end of this economic cycle. Failing to take any precaution might end up being an incredible poor decision for your future. Thanks a lot for listening to my episode again today, for liking the video, for subscribing to my YouTube channel. I would like to remind you the special offer that we have at Synax till the 30th of September to access 1 month free unparalleled stock market intelligence and then lock in a 1-year subscription for just $15 US. Thanks a lot for supporting me on X, for following me on Instagram, and for reading and commenting my articles on JustDario.com.